Hello, welcome to the Invest in Value channel. I am Victor, and in this video, I'm going to go over Warner Brothers Discovery. This is a new company that was the merger of Warner Brothers and Discovery. The three things I look for in a good investment is I want a discount on that investment. The bigger, the better. I want a company that is operated and performing well, and I want to know that it's the right time to buy. That's what I'm going to do. I'm going to scorecard this particular stock and give you my opinion on the stock. Before I jump into a full analysis of Warner Brothers, do me a big favor and like my video. Consider subscribing to my channel. Hit that bell if you want to be notified when I release a new video. Now, let me tell you more about Warner Brothers and Discovery. So Warner Brothers is, about 100 years old. It's a legendary studio that's made just countless good movies. They also have really good shows on HBO. They've been really providing or producing great content that has been well received by the public. They've had to navigate into COVID because, a lot of the movies that Warner Brothers created would end up in movie theaters, but movie theaters were pretty much non-operated in the last 2 years. Really, the last year they've been coming back, but nothing like it was in 2019. Discovery, on the other hand, has always been either a cable channel and then more recently a streaming service. And they have been a very good performing company, just great cash flow. I was an owner of Discovery before this acquisition. And with the acquisition, it makes it more interesting to me. I really like Warner Brothers. I think they're one of the best studios, on the planet. And the combination to me has a lot of potential. I really like that the CEO of Discovery is going to guide the combined company, because that CEO, I believe, knows how to create value for a stock. He really commits to free cash flow. He really has that type of financial drive and discipline to make sure that they're getting themselves into businesses, getting themselves into projects that are going to yield a profit and return value to the shareholder. So the combination I really like, but the numbers need to line up, and I'll be doing a full analysis on this video. Now let me show you more about this combined company. So the combined company has really been trading for less than a month. It got listed in early April, and it hasn't been a pretty picture so far. It's down 20%. Today alone, it's down quite a bit, but the market itself is down quite a bit. I think the S&P at this point, it is April 26th, midday. The S&P is down 13% or so. So it's not like Warner Brothers is the only company that's down. This one I think is down quite a bit because there's a lot of question marks out there. And frankly, I have a few question marks that will be answered over time. They can't be answered immediately. So I think that uncertainty combined with market conditions really makes for this stock to be really hammered down. I bought some shares today. I believe in the company, so I'll buy it at a discount because I believe that they are valued way more than $20.58 a share. Now, looking more historically at the Discovery stock, this is the stock that existed before the merger, and Warner Brothers was a part of AT&T before the merger. So I'm going to show Discovery since this management team's the team that's going to manage the go forward company. And again, I really liked the company before the merger, before it was even announced. The stock was doing quite well. If you've owned the stock for 5 years, you're still up 50%, which is really good. Archegos was a hedge fund that bought into Discovery and some other companies, and they there was a short squeeze on this particular stock that was created by Archegos that had some positions on this stock, and it made the stock just rise incredibly high and then drop incredibly fast. Whenever this type of event happens, I exit a position. I own Discovery, and I saw this happen. I couldn't explain it, so I sold, and I sold at a big gain, and then it collapsed, and I waited a while, and then I bought again. But the stock price, Jeff Bezos of Amazon I like one of the quotes he said is, "The stock price is not the company, and the company is not the stock price," was his quote about Amazon after the dot-com bubble. He was pointing out that the company was operating really well and growing really well. 20 years later, Amazon's just such a, great example of an awesome company. So applying that type of logic to Discovery and the combined company, I think is applicable, which is all this happened, because of a hedge fund and some shorts and so forth. That isn't representative of how, maybe volatile the Discovery business is, nor just, out of control. It's actually just some market conditions that existed. But the company, I think, is a really good company. It produces great cash flow. And that's one of the things that I really favor. If you watch my videos, that's the number one input into my investment thesis. So I wanted to point out that, it wasn't Discovery's fault that, their stock was really affected by this hedge fund manager. I believe he borrowed a lot of money and then he couldn't pay back or service the loans that he had taken. And he bought a lot of shares on margin, and the whole thing collapsed. He was using kind of a family fortune. He overextended himself, and that major sell-off is what created the big drop in Discovery. Again, it wasn't Discovery's making, it was just a market condition, and that happened at that peak. And I sold and I made money. So I hated to see the business affected, but I'll take the money and run. All right, now let me tell you what I think this company is worth. With such a young company, I'm gonna have to take some broad assumptions, but let me take you through what I calculated. First, I'm using a discount rate of 9%. Historically, they've grown 18%. So I'm gonna grow free cash flows by 15% in the first 5 years, and then 5% from years 6 to 20. And if I use that as the assumption of what cash flows look like over the next 20 years, I'm starting, by the way, with just Discovery cash flows. And if I do that, it's just a conservative way of calculating free cash. If Warner Brothers brings free cash to the combined company, these numbers would just get better. Net present value is $50 billion for the combined company based on my model. The market cap is $48.6 billion. So this company is pretty much fairly priced. There's a value per share that my model's calculating of $20.61. It's currently trading. It's midday right now. It's April 26th. It's trading at $20.43. So pretty much fair value. You're getting a slight discount. So it's priced fair. Now, the leap or the thesis that I'm making is that the Warner Brothers business is going to bring added value. I just can't put a number on it yet, so I just don't want to guess at it. I think this is a good place to leave my valuation and then make decisions on investing on other assumptions that I can make in this stock. Looking at the performance, especially of Discovery, it was very good. They grew their revenues by 13%. Their PE is 13.97. So that's a really good PE for a company that's been growing well and very profitable, generating a lot of free cash. Just Discovery alone generated $2.4 billion of free cash. HBO has a lot of momentum. They have 77 million subscribers. I know Disney Plus got a lot of fanfare when they got to 50 million subscribers. I believe they're near 100 million subscribers. Well, kind of in a little bit of secrecy, HBO got a lot of subscribers, 77 million. And this is a premium service. It's priced higher than the typical service out there. And, I'm a big fan. I love HBO. It's probably my favorite channel. They have the more interesting shows. And I think it's all about content. If you have the right content, people are going to pay to watch your content. Now, 2022 is going to be a bit messy because you have this combination of companies. I think financials are going to look a little messy for 2022. But the company, I believe, has momentum. I really like that the CEO of Discovery is going to run the combined company because he really knows how to operate companies so that they return value to shareholders. He knows how to, really focus on generating free cash, profit, and so forth. So I think that type of discipline is going to be a good thing for the combined company. Warner Brothers is a big business. It generated $8.6 billion just in Q1. That was part of the AT&T financials, but that is really, really good. One thing that was concerning, and I think driving the stock price down, is that Warner Brothers, the free cash flow was actually negative. So if that persists, that's going to be a problem. But I think that was a one-timer. And we'll see when the combined company of Discovery and Warner Brothers report in roughly 3 months, we will see if that was just a one-time thing. My outlook is there's upside in this stock. It is upside based on the fact that you're taking two really good companies, and those two really good companies in the same domain, same industry, will just create greater revenue, greater profit, greater free cash flow. So that combination, I believe, is worth a lot more. I just can't put a number yet. I know that the stock is fairly priced at this moment, but once you start seeing the numbers roll in and we can believe those numbers, I think this could be a 2, 3, 4 bagger in the next 18 months. I have a pretty significant position of WBD. I'm going to keep increasing my position. Part of it is that I think the market's really fearful right now, and Warren Buffett says, hey, buy when people are fearful. That's when you get a discount. So I'm buying more WBD. I'm also buying a lot of other growth oriented companies. I'm buying Netflix, and I'm also buying Paramount. So how does Warner Brothers Discovery score on my scorecard? Want a discount on investment, and for this particular company, it's at best a question mark. I think more time is needed. They need to get through a few quarters, maybe a full year, and then we could see how profitable this combined company is, how much free cash flow is being provided. I believe that the management team is really good. They're veterans of this industry. They really know how to navigate the company. I think this is the company that's going to be the main competitor to Netflix. But both Netflix and Warner Brothers Discovery are going to prosper, in my opinion. The timing is not ideal. Again, we don't have enough, combined data to really form a strong, value comparison between stock price and where the intrinsic value is. So really, this is one where I'm making my decision on gut instinct that, hey, this is going to be valuable because of the combined company. And once the data supports that theory, then the stock's going to pop. That's my theory. It's, we all make our own investments, but based on the financials, this is the scorecard. It has 1 check mark, 2 question marks, and that's my opinion. So this video is for entertainment purposes only. I'm not recommending that you buy WBD or Netflix or any other stock or security. Please weigh your decisions seriously, and I hope you found this video interesting. Thank you for watching my video. I really appreciate it. Do me a big favor and like my video. Consider subscribing to my channel and hit that bell if you want to be notified when I release new videos. Thanks again, and good luck investing in 2022.